Good afternoon. Thank you for joining Mayer Brown's Global Financial Markets teleconference series. Today's call is entitled IBOR Replacement, Key Points for Derivatives, Structured Finance and Loan Hedging. My name's Ed Parker and I'm a partner in Mayer Brown's London office, and I'm the Global Practice Head of the Derivatives and Structured Products practice. I regularly advise on complex OTC and structured credit, equity, FX and commodity derivatives, as well as insurance and pension-like derivative structures. I also advise on central clearing issues and derivatives regulation together with our regulatory team. But first, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or indeed forward it to any of your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not be having a Q&A session, if you have any questions, please send those regarding today's topic by email to gfm@mayerbrown.com and we will respond promptly. This is the same email address as on your invitation email. Now, a brief introduction to our speakers for today's call. Joining me from Mayer Brown Derivatives and Structured Products team are Patrick Scholl, Brad Berman, Nanak Keswani and Emma Khoo. Patrick is a partner in our Frankfurt office. He works primarily with major financial institutions as well as corporates and sovereigns. Patrick Scholl regularly advises on debt capital market transactions, debt issue programs, derivative products and repackagings. Brad Berman is a counsel in the New York office focusing on advising domestic and non-US issuers on domestic and international securities offerings of structured products linked to equities, commodities, interest rates, currencies, and other underlying assets. Nanak Keswani is a counsel in the London office focusing on derivatives and structured finance. Nanak has extensive experience in advising on OTC and structured derivatives for banks, corporates, funds, pension schemes, and insurance companies. And Emma Khoo is a senior associate in our London office as well, focusing on non-contentious regulatory law with a particular focus on derivatives. She regularly addresses compliance issues and cross-border issues in the financial services sectors, including the authorization of financial institutions under UK and EU law, individual conduct issues, in particular the regulation of senior persons, and on financial crime. So, with those brief introductions, I'm pleased to begin today's presentation. And in our packed session, we will be discussing the background to the timetable for IBOR replacement and impact of COVID-19 on that, an update on the ISDA consultation on pre-cessation triggers and the effect of this, spread adjustments, the transition from EONIA under ISDA and DRV documentation, issues and considerations for other structured products in the United States, including CMS rate-linked products, embedded swaps, where we're looking at the key issues when a loan or structured finance arrangement has an embedded swap, and fallback considerations for legacy transactions, in particular looking at implications under the benchmarks regulation of existing fallbacks for calculation agents and corporate trustees, and the move to alternative sources and rates as fallbacks. So, a lot to pack in today, and let me commence with our discussion on the background to the timetable for IBOR replacement and the impact of COVID-19. There may be some listeners on the call who remember life in finance before interbank offered rates, the IBORs, such as the London interbank offered rate, LIBOR, became the dominant as the accepted benchmark interest rate, representing short-term unsecured borrowing for the largest banks. But I imagine there are very few of you who are those listeners who have such a long experience in the markets. The IBORs, since their creation, have snowballed in importance and becoming interest rate benchmarks to possibly as much as $350 trillion and by some estimates $500 trillion of bonds, loans, derivatives, structured products and mortgages relied on by corporations, banks, governments and retail consumers. Presently, LIBOR is calculated for 5 currencies across 7 tenors on the basis of daily submissions from 20 banks. And these banks submit prices to reflect the interest rate at which they would be able to borrow on an unsecured basis in the wholesale markets, which are then averaged out and published to give the LIBOR rate. A series of IBOR-related scandals, though, arose from the financial crisis, and listeners, I'm sure you will be very familiar with these. And these have resulted in close scrutiny of the IBORs from global regulators. Initially, the regulators tried to reform the IBORs, and the 2012 weekly review of LIBOR recommended retaining a fundamentally reformed LIBOR. And indeed, this started to happen with ICE benchmark administration taking over the administration of LIBOR and the FCA becoming the IBOR regulator. In 2013, July that year, the International Organization of Securities Commissions, IOSCO, released its principles for financial benchmarks, and these became the underlying rules across all the IBORs. In 2017, though, the FCA announced that it would no longer force or persuade LIBOR panel banks to submit LIBOR quotes from the end of 2021. Other regulators piled in, making it clear that discontinuance of LIBOR at the end of 2021 was a certainty, with the transition to other risk-free rates to take place by then. The first step in this IBOR transition has been to choose alternative reference rates, ARRs, which will are the risk-free rates which will replace the IBORs. Various cross-sector and jurisdiction industry groups such as ISDA, ICMA and AFME have helped identify those replacement benchmarks and provided related consultations to the market to help establish new conventions and transition approaches which are ongoing. And as we stand today for USD LIBOR, SOFR, the Secured Overnight Financing Rate, SOFR, is due to become the replacement alternative reference rate. For Euribor, Ionia and Euro LIBOR, it's going to be ESTR, ESTR. And for GBP LIBOR, Sterling LIBOR, it will be a reformed version of the Sterling Overnight Index Average, SONIA, SONIA. So, with COVID-19 being such a current issue, we ask the question, in the regulator's eyes, will this lead to a slowing of the transition period? Well, the answer is currently no. On 25th of March this year, the FCA, the Bank of England and members of the Working Group on Sterling Risk-Free Reference Rates stated in a press release that the central assumption that firms cannot rely on LIBOR being published after the end of 2021 has not changed and should remain the target date for all firms to meet. So, notwithstanding the unprecedented disruption of COVID-19 to the financial markets, IBOR transition preparation must continue unabated. So, I now turn to Nanak Keswani to give an update on ISDA consultations on pre-cessation triggers and the effects of this. Over to you, Nanak.
Thanks very much, Ed. Since 2016, ISDA has been working on fallbacks for certain key IBORs used in derivative contracts, including Euribor and GBP, USD and Euro LIBORs. ISDA has consulted market participants several times to establish industry-wide preferences with respect to these fallbacks. A key part of these consultations is centred on the calculation of the fallbacks, given that they will be based on overnight risk-free rates, as Ed said, and these risk-free rates neither replicate the term nature of existing IBORs, nor price in other risks included in IBOR determination, such as bank credit risk premium. To address this, market participants have determined, by way of these ISDA consultations, that fallbacks in ISDA documentation should be calculated based on, one, a compounded setting in arrears rate, that being the relevant risk-free rate observed over the relevant IBOR tenor and compounded daily during that period. And secondly, a spread adjustment based on the median spot spread between the relevant IBOR tenor and the adjusted risk-free rate calculated over a fixed look-back period. Initially, these fallbacks are due to apply only upon the actual discontinuation of the relevant IBOR, following an announcement by the IBOR administrator, relevant authority or a court that the IBOR administrator would cease to provide the relevant IBOR and that there would be no successor administrator. However, at the request of the Financial Stability Board Official Sector Steering Group, ISDA consulted the market on whether to add a pre-cessation trigger to the permanent cessation triggers for LIBOR in its documentation, with such pre-cessation trigger taking effect if the UK Financial Conduct Authority finds that LIBOR is non-representative. A majority of market participants who responded to ISDA's first consultation on this in May 2019 were of the view that they would not want to continue referencing LIBOR in derivatives contracts in such circumstances. However, there was no consensus on whether to implement a pre-cessation fallback trigger or how to do so. Following the results of this first consultation, ISDA were asked by the steering group to include a pre-cessation trigger in the documentation produced by ISDA to amend legacy transactions. Having consulted with regulators in the industry about the implications of a non-representative LIBOR, and in particular how long such a non-representative LIBOR might continue to be published before its cessation, ISDA launched a second consultation on pre-cessation triggers in March this year. The preliminary results were announced by ISDA in April this year, which showed that the majority of market participants that have responded were in favour of including both pre-cessation and permanent cessation fallbacks in ISDA documentation for amending legacy trades. It should be noted, however, that the updated ISDA documentation for other key IBORs on which ISDA is consulted will continue to include permanent cessation fallbacks only. I will now hand back to Ed to discuss spread adjustments in more detail.
Thank you very much, Nanak. And over to spread adjustment issues. Commonly, a derivative or other financial instrument refers to both an IBOR rate and a spread. And when transitioning from an IBOR rate to one of the risk-free rates, this causes an issue. The risk-free rates are not the economic equivalent of LIBOR, and they need to be adjusted to account for, firstly, the fact that the risk-free rate is not an overnight rate, and it isn't a term rate either, and also some of the various premia which are built in to LIBOR, such as the bank credit risk element or term liquidity premiums, are not included in the risk-free rates. And so that needs to be taken into account in a spread adjustment. And it means that in most cases, the RFRs that are expected to be lower than their LIBOR equivalent, and consequently, the spread adjustments needed to minimize the economic impact of moving to a risk-free rate. So, in addition to considering when your IBOR transition in your documents will take place and managing the whole process of amending those documents, market participants also need to consider the amendment that will need to be made to any spread and to agree that. And there have been a few developments with regard to spread adjustments recently. ISDA has issued a series of consultations on the subject. It's supplemental consultation on spreads and terms adjustments, on methodologies for calculating spread adjustments, on the permanent cessation of LIBOR and derivatives transactions has been released, and the majority of participants in that consultation preferred a historical median spot spread approach between the IBOR and the adjusted risk-free rate, calculated over a 5-year look-back period. In response to that, ISDA expects to proceed with developing benchmark fallbacks for use in its standard definitions based on the historical median over the 5-year look-back period for spread adjustments. In the United States, the Alternative Reference Rates Committee, ARC, released back in January of this year a consultation paper on potential spread adjustment methodologies for fallbacks in cash products which reference USD LIBOR, which would take account of the differences between SOFR and LIBOR. And this consultation was opened up for comments in early March. Finally, the working group on sterling risk-free reference rates released back in December of last year a consultation paper for the sterling cash market on appropriate methodologies to calculate the spread adjustment when a fallback is triggered. The aggregated and anonymized summary of responses has now been published, and the working group will discuss the results at its forthcoming meeting. So there are various outreaches that are in progress on the spread adjustment issue, and following that is absolutely key as we move through the IBOR transition process. So with that, I will hand over to Patrick Scholl to discuss the transition from Ionia under both ISDA and German DRV documentation. Patrick, over to you.
Thank you very much for joining today, and hello from Frankfurt. My name is Patrick Scholl, and I give you an overview of the current transition from Ionia to ISDA. As Ed mentioned before, ISDA is the new Euro short-term risk-free rate published by the European Central Bank, the ECB. ISDA is published since 2nd October 2019 at 9 o'clock in the morning, Central European Time. ISDA is based on transactions conducted and settled on the previous target's business day. For information on ISDA, we always recommend the ECB website with all important information, ecb.europe.eu. The existing Euro overnight index average, called Ionia, will not be made benchmark compliant and will be discontinued on 3rd January 2022. Since 2nd October 2019, Ionia will be used with a modified methodology. The value of Ionia since then is equal to ISDA plus a fixed spread of 8.5 basis points. Based on the recommendations of the working group on Euro risk-free rates, the market needs to prepare for the transition from Ionia to ISDA. With regard to OTC derivatives, Ionia is often used as the basis to determine interest for cash collateral under credit support documentation, but also as a floating rate option in interest rate swaps, or as calculation base of other variables in an OTC transaction, like refinancing costs. New market conventions for ISDA-based interest rate swaps have been published by ISDA in the supplement 59 to the 2006 definition. This floating rate option is called EUR, Euro STR compound. For the purposes of the transition, ISDA prepared and published an Ionia bilateral amendment agreement. With regard to Germany, a form of an Ionia amendment agreement has been made available by the German banking industry. This means in both cases, a repapering of existing transaction documentation is required on a counterparty per counterparty basis. There is no uniform solution available like an ISDA protocol to transition from Ionia to ISDA with regard to a whole portfolio. The ISDA bilateral amendment agreement makes use of a new set of definitions published by ISDA for collateral arrangements. These definitions are called the ISDA collateral agreement interest rate definitions and set out the available definitions for Ionia and ISDA in credit support documentation, as well as fallback provisions in case of cessation events. ISDA is defined in such definitions as the Euro STR. The agreement does not only cover credit support documents like the CSA. Counterparties can also use it to amend transactions based on Ionia floating rate options and for other Ionia references in transactions. In order to transition to ISDA, the agreement gives counterparties several options they can use and agree with their counterparties. The agreement also gives the counterparties the option to amend specific documents only or all documents in place. The DRV-based documentation applies to each of the German Master Agreement for Financial Derivatives transactions, the German Master Agreement for Repurchase Transactions, and the German Master Agreement for Securities Lending Transactions. By way of this amendment agreement, counterparties can amend related credit support agreements as well as EONIA-based floating rate options and other terms referencing EONIA. Both documents enable parties not only to agree on the specific replacements for EONIA, they also enable the contracting parties to agree on a compensation payment. This compensation payment can either be documented directly in the agreement or in a separate arrangement. It needs to be agreed between the parties by when the compensation arrangement should or must become effective in order to successfully transition to ESTR. We generally do not estimate very complex negotiations of these arrangements. However, with respect to the compensation payment, but also in view of the techniques and options provided in the arrangements, counterparties will need to decide what will be the best way to efficiently structure the repapering exercise. Finally, I want to shortly touch base on EONIA transition in connection with clearing. For example, Eurex Clearing AG currently uses EONIA to discount cash flows since the price alignment interest, the PIA, applied to variation margin is EONIA. Eurex Clearing AG intends to switch to PIA based on ESTR from the 27th July 2020 on. This means that the discounting of all cash flows will be switched to ESTR flat. This will result in a change of the present value of all euro-denominated clear OTC transactions. To counter for such an adverse effect to the largest extent possible and to design a P&L and liquidity-neutral discounting switch, Eurex Clearing is looking to deploy also mandatory cost-cash compensation mechanism between the participants. Market participants should therefore check whether the timing of the EONIA transition takes also into account the transitions indicated or planned by clearing houses and other market infrastructure providers. With this final note, I'm ending my presentation on the EONIA transition and hand it over to Ed Parker.
Patrick, thank you very much. And now I turn to Brad Berman to discuss issues and considerations for other structured products in the United States, including CMS rate-linked products. Brad, over to you.
Thank you, Ed. At a very high level, what's happening in the U.S. right now is banking and other financial issuers are building in the ARC fallbacks to SOFR into the U.S. dollar LIBOR terms in their banknote and MTN programs. And I'd just say we are seeing very, very few U.S. dollar LIBOR issuances at this point. These same issuers are beginning to include SOFR floating rate note provisions in these same programs, and we see large banks are doing SOFR floating rate notes. The ARCs released sample term sheets for 4 different types of SOFR floating rate note calculations, which I'll discuss. And also the ARC submitted a legislative proposal to the New York State Legislature to solve the issue of legacy U.S. dollar LIBOR floating rate notes that will ultimately default to fixed rate notes. Now, on the CMS, or constant maturity swap rate, we haven't heard much about that, but it's kind of interesting what's going on with that. The issue is the floating rate leg of the CMS calculation looks to LIBOR. So the result is really once LIBOR ceases, that floating rate leg is going to default to SOFR under the ISDA definitions. So if you're going out with a CMS rate note, you really want to include a risk factor and note that the CMS rate is going to change at some point, and depending how effective the spread adjustment is that was discussed earlier, we don't know if it'll go up or down. So certainly worth a risk factor if you're going to go out with a CMS note. Now, the second element of drafting for CMS, if you're including it in an MTN program, is how do you draft the fallbacks for the rate? In other words, the calculation agent turns on the Reuters screen, there's no CMS rate, okay, we have to reconstruct it. What do we use for the floating rate LIBOR leg? It should be clear that if you're doing this before LIBOR ceases, it's going to drop to SOFR. If you're doing it after LIBOR ceases, the floating rate leg will be based on SOFR. So now let's mention the ARC's term sheet. And really this is the ongoing saga of how do you calculate a term interest rate with a daily rate. You know, good old LIBOR, 3-month LIBOR in the beginning of the interest period. You knew the rate, you knew the payment, end of story. Okay, when you're trying to construct, until they come out with term SOFR, which won't be for another year or so at least, what you have to do is compound daily rates and figure out what the rate over the term was at the end, and the issue becomes, do the holders and the issuer have any notice by the time you get to the interest payment date? So there's a couple of ways that ARC has come out with for how to create a little notice period. There's what they call look back, and essentially there the daily SOFR rate for each day in the interest period will be the daily SOFR rate for a certain number of U.S. government securities business days before the date of determination. So if you had a 5 U.S. government securities business day look back, you've built in a 5 business day period between the last day of calculating interest and the payment. So that gives people some notice. Another way to do it is what they call observation period shift. Essentially, they shift the interest period back a certain number of U.S. government securities business days prior to the relevant interest payment date. Again, that gives you a little more time. And then payment delay, as the title implies, that simply delays payment for 2 business days or so after the interest payment date. So your calculation is going from and including an interest payment date to but excluding the following one or the maturity, and then you're just going to get paid a couple days later. The 4th term sheet came out is really pretty interesting because what they have created now is a SOFR index. And one of the things in the 3 previous sheets, and one of the concerns about users is SOFR had to be compounded. There's a formula. There were questions, are people's systems ready to do this? It's extra work. What the SOFR index does, it is an index of SOFR compounded since April 2, 2018. So all the compounding is built into the index. All you have to do with the index is pick 2 dates, your start date, the beginning of your interest period, and your end date, the end of the interest period, compare the 2 rates, and you get a rate. Now, of course, much as in other structured notes, like something linked to the S&P 500, when you have a start date and an end date, in this case, if the rate was higher at the end date, you'll have a positive rate. If it's equal to the starting rate, you'll have a 0 rate, and if it's less, you'll have a negative rate. So you want to make sure you floor your documents at a 0 rate. So, and you can pick any interest period you want using the index. The last point was, again, the question of legacy U.S. dollar floating rate notes in the United States. If you want to adjust an interest provision in an existing note, you need 100% consent of the holders, which you will never get. So the ARC submitted a legislative solution to the New York State Legislature, which, by the way, they adjourned without getting to it. I think they had COVID and other things on their mind. But essentially what the proposed legislation would do, it would replace the existing LIBOR fallbacks, or based on the 2006 ISDA definitions, by applying the ARC recommended SOFR fallback across all asset classes. Obviously, they're trying to avoid litigation when these legacy contracts end up become a fixed rate instrument, or some things like loans are just silent about it. So what it does is it legislatively would eliminate the polling provisions from the 2006 ISDA provisions, and it would just automatically fall back to the ARC recommended SOFR replacement provisions. So that's the current state in the U.S. Back to you, Ed. Thank you.
Brad, thank you very much. And now to turn to embedded swaps. What are the key issues when a loan or structured finance arrangement has an embedded swap? Let's take the most common structured finance arrangements where IBOR transition is important. These are the large real estate finance loans, the project finance loans, securitizations, structured products, and repackaging transactions. These transactions will often integrate with an interest rate swap, which reprofiles a fixed rate or a receivables amount into a floating rate. The embedded swap will be documented under an ISDA master agreement, and within its schedule, it will restrict the ability of the borrower under a loan or issuer under a structured note and the hedge counterparty under the ISDA master agreement to make amendments to the swap without the agreement of the lenders or the note holders. And further restrictions will also be set out in the loan agreement itself or in the conditions of the notes. So transitioning from IBOR, an IBOR to a risk-free rate has an additional level of complexity to those we tend to see in standard derivatives or loans, which embedded swaps bring. The restrictions in a structured finance loan agreement or its embedded swap will not usually allow an amendment of an IBOR rate without the consent of the lenders. And this is simple enough if it's a bilateral loan, but it's complicated where there's a syndicated lending arrangement and the consent of multiple lenders may be required. The relevant loan agreement will require, of course, amendment of the IBOR rate, but also the spread for the reasons we've discussed when we covered spread adjustments. And this again can be complicated as there could be multiple viewpoints from different lenders within the lender group or from note holders or indeed the borrower itself, both as to what how the spread should be adjusted and when the amendment should take place and whether anybody is going to be disadvantaged by that. The timing of those amendments can be a particular issue. A borrower could find that it's dealing with various different lender groups across all of its different loans, and the loan agreement, although it could be based on a market standard form, such as one of the LMA forms, would still require careful review to see if there had been transition provisions built in or there were other different nuances. In the case of a securitization, a repackaging or structured note, a unanimous note holder resolution or a note holder meeting would be required to effect the change, and this will have to be organized together with the trustee and the agents. The whole process may be more complex and laborious than would initially meet the eye. So our suggestion to arrangers, note holders and borrowers is to act early in preparing for IBOR transition with these products, and as with all matters we've discussed today, please do consult us if we can be of any help. So with that, we will go on to our final topic, fallback considerations for legacy transactions, and I'm going to turn to Emma Khoo to discuss implications under the benchmark regulation of existing fallbacks for calculation agents and corporate trustees before handing over to Patrick Scholl on the last aspect of that. Emma, over to you.
Thank you, Ed. In relation to English law transactions, there is certainly a risk that discretionary powers could bring calculation agents and corporate trustees within scope of the use of the benchmark definition of the benchmark regulations, of the BMR, and therefore trigger BMR compliance. For anyone who hasn't seen this yet, the part of the BMR definition of use of a benchmark that is relevant to calculation agents covers the determination of the amount payable under a financial instrument or a financial contract by referencing an index or a combination of indices providing a borrowing rate calculated as a spread or markup over an index or a combination of indices, and that is solely used as a reference in a financial contract to which the creditor is a party. However, so long as the calculation agent's exercise of discretion is very narrow, then they should be out of scope of the BMR. In particular, ESMA explains in its questions and answers, Q&As, on the BMR that calculation agents usually do not set the terms of the financial instrument and do not decide which benchmark is referred to by the instrument. Their role is simply to calculate, on behalf of the issuer, the payment due on the basis of predetermined terms, including the benchmark to be used, which they cannot amend. Therefore, in its Q&A, ESMA goes on to explain that it considers that calculation agents in particular, in this particular context, are not users of benchmarks under Article 317 of the BMR if the issuer of securities has set the terms of the financial instrument that references the benchmark. However, the language in some legacy deals may include fallback language, which places discretionary powers in the hands of the calculation agent, such as selecting replacement rates. Depending on how much discretion can actually be exercised by the calculation agent, and if those discretionary powers actually mean that they can decide which benchmark is referred to by the instrument, or if they can set other terms of the financial instrument, those calculation agents may fall within the definition of use of a benchmark under the BMR. If so, they may inadvertently trigger time-consuming and costly compliance requirements under the BMR, such as producing and maintaining robust written plans setting out the actions to take in the event that a benchmark materially changes or ceases to be provided. I'll now hand over to Patrick to discuss the other part of fallback considerations.
Thank you, Emma. For the remaining minutes, I want to briefly describe the anticipated developments on contractual fallbacks for interest rate derivatives. ISDA is currently updating the 2006 definitions for interest rate swaps. As part of this work, a main updated booklet of the definitions is intended to be published in this year, together with an annex setting out all applicable and updated floating rate options. In connection with these floating rate options, also fallbacks will be modernized and developed for existing rates like the IBORs as long as they are in use, as well as, for example, the modified EURIBOR. Upon the publication of these new standards, a differentiation on the application of fallbacks will have to be made. If the selected screen rate is not available on the applicable business day, it has to be determined whether a cessation event has occurred or not. If no cessation event has occurred, a substitute determination of the applicable reference rate will have to be applied. As of today, these substitute determinations are mainly based on quotations obtained from reference banks. These reference banks base polls could going forward be replaced, given current market experiences, by other alternative determinations based on either other publication sources or on available alternative rates, so like short-term rates. If a cessation event has occurred, however, this cessation event will be defined with respect to a certain reference rate. The new definitions will provide for a waterfall of fallback provisions specific to each reference rate. This means in particular that a specific fallback rate will be specified and that existing provisions providing for a more general language as regards the consequences of a cessation, like in the ISDA benchmark supplement, will no longer apply or might have to be amended. This increases contractual transparency for counterparties and a uniform market response to a cessation event. As just highlighted before, ISDA will likely also capture pre-cessation trigger events, in particular if the selected reference rate is no longer representative, but the details are still being developed. With regard to legacy OTC transactions, ISDA plans for the publication of a protocol which enables the market to adapt to these new standards also for legacy transactions. This means the following. If interest rate swaps will be aligned to such contractual provisions, other instruments that will be hedged by such ERS swaps might need to be aligned to these new standards as well. And my colleagues before already highlighted how difficult this could be. We also anticipate that clearinghouses will in due course also update their existing clearing conditions for cleared interest rate swaps to follow these market standards. These updates will likely also include legacy transactions. All details and specifics of these developments are not yet completely clear and available, and it remains therefore important to monitor the further development and to plan for the upcoming modifications with sufficient time to adapt. With this last note, I conclude this last part of our presentation and hand back to Ed Parker. Thank you very much for attending.
Thank you, Patrick. And with that, we end our talk today. Thank you very much to my co-presenters, Patrick Scholl, Brad Berman, Nanak Keswani, and Emma Khoo. And thank you very much to our audience for tuning in. 2 brief reminders. You will receive an email with a link to the recording of today's call. And as mentioned before, if you have any questions related to our content today, please email them to gfm@mayorbrown.com. Thank you very much for your participation. You may all now disconnect.